the best of Money Matters. Market View on Money FM 89.3.
You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. Taking a quick look at how the STI closed. It closed up at 0.2% at 4,307 points. U.S. President Donald Trump announced that his administration will impose substantial tariffs on semiconductor imports from companies that do not shift production to the United States. The move is the latest in a series of aggressive trade measures that have rattled global markets, fueled economic uncertainty, and raised fresh concerns about supply chains. At the same time, Trump has moved to cut tariffs on Japanese autos while leaving South Korean car makers at a competitive disadvantage. All this comes as the U.S. labor market shows fresh signs of weakness, with private payrolls growing by just 54,000 in August and layoffs jumping yearly 40%. Investors are now facing closely to see how these trade and labor developments could influence corporate earnings, equity markets, and the Federal Reserve's upcoming policy decisions. Now, for more market moves and views, joining us today is Benjamin Goh, Head of Research and Investor Education at SIAS. Hi, Benjamin. Happy Friday.
Hey, Alex. How's it going?
Doing great. Thank you. So the STI opened at 4,307 points today. What's your take on the movement so far? Were there any surprises or notable drivers behind today's performance?
Well, today's advance was largely led by the large caps. The sentiment driving today's performance really similar to overnight U.S. market in that market is expecting an interest rate cut given the worrying ADP non-farm employment numbers that came out in the U.S. last night. So as you saw just now, it came in way below the expected number. And of course, in view of an interest rate drop, then of course companies with large balance sheets, specifically debt, tend to benefit more from an interest rate cut. So it's really not surprising to see that the sectors doing well today include construction, real estate development, offshore and marine, as well as agriculture. All those were in the green today.
Now, U.S. President Donald Trump has announced that his administration will impose fairly substantial tariffs on semiconductor imports from firms not moving production to the U.S. He has floated figures of up to 100% tariffs, though he says they won't apply to companies that have already committed to U.S. fabs like TSMC and Samsung. So how damaging could these tariffs be to Asia's chip giants, and do you expect them to accelerate relocation of capacity to the U.S.?
Well, the answer is, I guess, not so straightforward. So TSMC, Samsung, as well as global foundries, they already have plants or setting up plants in the U.S. Depending on the product that the plant actually make, because there are different types of chips, they can be really, really expensive to set up. So if you take TSMC, for example, moving to a 3 nanometer node will cost them billions of dollars, actually. And then if you look at the product where chips go into, for example, a car, even a traditional internal combustion engine car that is using petrol, nowadays cars have actually a few $100s worth of chips inside. And some of these chips are actually quite easy to make, so they only cost a few dollars. So it's really hard to justify spending millions of dollars building a new plant in the US just to make $5 chips. So what may happen in the future is that you're going to have a bifurcation of the fab industry. So U.S. plants will make chips mainly for the U.S. market, more of the high-end, high-margin products, and chips for non-U.S. companies will then be made in non-U.S. plants. So, continued production in Korea, Japan, Taiwan, so on and so forth. I think, production of chips in the U.S. is probably going to rise, given what's been happening with the Trump policies these days. But it is probably not going to rise as much as the U.S. government would like.
But if tariffs do bite, how much downside risk do you see for semiconductor equities, given that chip makers already trade at high multiples on the back of AI demand?
Well, I think the impact is probably going to be limited. So again, if you take the example of TSMC and NVIDIA, am I using those as examples? Because those are the AI market leaders, right? So the profit margins for TSMC and NVIDIA are about 40% and 60% respectively. So that's huge. So if you do have tariffs, yeah, it's going to be some impact, but it's really hard to replace these companies with alternatives. And obviously some of the cost increases are going to be passed down to customers such as Microsoft, Meta, Apple, who will then, of course, pass them down to end users such as you and me. So I think it's going to impact these companies, but not to the kind of extent that we think, is suggested by the headline news. I think the main risk factor is not really tariffs. I think it is the investments in AI not fetching the returns that the market expects. So the market is giving these companies quite a bit of leash to basically run. So given some time, the market will expect some kind of return. So if that doesn't happen, then of course the whole narrative behind the AI revolution will fall down. And of course, companies already trading at high multiples are going to have a correction.
I see. Now, switching to autos, Trump just cut tariffs on Japanese auto imports from 27.5% down to 15%, while South Korean car makers like Hyundai and Kia are still facing the 25% rate. Now, Japan's auto sector represents about 8% of its total employment, while South Korea depends heavily on exports to the U.S. How do you see this uneven tariff treatment affecting competition between Japanese and Korean automakers in the U.S. market? And does this signal that investors should be rotating into Japanese auto stocks over Korean ones?
Well, I think the impact of the tariffs may not be as significant as the headlines may suggest because of the companies that you have mentioned, Hyundai, Kia, and of course, Toyota, Honda, so on and so forth. All of them have actually manufacturing plants in the U.S. already, right? So those plants in the U.S. will continue churning out products for the U.S. market. And for whatever products that these companies need to import from their home countries, well, if you look at the FX foreign exchange rates for the last 5 years, the Korean won as well as the Japanese yen have actually been depreciating quite a fair bit against the US dollar. So yes, tariffs push costs up, but because of the depreciating, home currencies, then obviously that will offset some of the tariff or some of the cost of the tariff. So the sticker price is not going to be as large as what you might expect. I think the longer view is that, and this feeds into your second question, the longer view is that Japanese and Korean auto stocks, I think the conversation should not be whether or not Korean stocks or Japanese stocks are better. I think the larger conversation should be whether or not, automakers from these countries are going to be wiped out by BYD and other Chinese automakers. So tariffs are not the existential threat for Japanese and Korean car makers. It is actually the Chinese automakers because they have got products with really, really compelling value propositions. And I'm sure you've taken a Grab or a taxi in Singapore with a BYD. They are really sexy, right? I mean, the lights and they're well made, and of course they're new, so we don't really know whether they're going to last for the full 10 years for the COE. But they're really compelling based on the kind of prices that they're charging, right? So I think that's the threat for Japanese and Korean car makers, not really the tariffs, but the Chinese are coming for them.
Okay. Well, looking at AI, OpenAI is reported to be working with Broadcom to launch its first in-house AI chip by 2026, following Google, Amazon, and Meta, who already designed their own. Is this the start of a new growth cycle in semiconductors, or could we be facing the risk of oversupply and even margin pressures once all these new players ramp up production?
Well, if you look at the in-house AI chips developed by all these companies, those chips tend to focus on inference, not training. So inference is, when you get the model to predict or give you a reply. But before that, the model actually needs to be trained. So by and large, most of the models out there, ChatGPT, Gemini, so on and so forth, they mainly use NVIDIA chips for training. So we are really talking about two different types of AI chips, and they are for different use cases. So not the same thing. And, moreover, we're still in the AI build-out phase. So as the cost of AI comes down, invariably that will lead to an increase in AI usage. So at some point, the demand and supply is going to balance out, but I don't really think that's going to happen anytime soon. So looking at the industry reports, the forecasts, the case studies by McKinsey, we're probably still going to have quite a fair bit of runway to go, at least for the next 5 to 10 years before we get to a saturation point.
Now let's look at the U.S. labor market. Private payrolls rose just 54% in August, which was well below expectations of 65,000 and down sharply from July's 106,000. At the same time, layoffs surged nearly 40% year on year to almost 86,000, which is the highest August figure since 2020. And the unemployment rate is now forecast to tick up to 4.3% from 4.2%. How worried should investors be about this clear slowdown in U.S. hiring?
Well, I guess it's not the end of the world, but we can see it from here. And that is one data point. Tonight is going to be another data point because that's when the U.S. jobs report, the non-farm payrolls, is going to be coming out back to back. So the surprising news, in 2023 and 2024 was how robust the U.S. labor market was, despite the worries, despite the economic headwinds. But what has changed this year is obviously the imposition of U.S. tariffs. That really has changed the underlying economic structure. So it's not just headline news, it's not just the politics, but really, this is the new normal, right? So if you look at it, about 2/3 of U.S. economic growth is driven by consumption. So a weak U.S. labor market reduces consumption, which will, of course, then reduce U.S. growth. So that's why it is very worrying. But that was yesterday's data point. Tonight, jobs report coming out. Let's see whether that actually reinforces the worry from yesterday's report.
But the labor market weakness is actually being linked to Trump's sweeping tariffs and even tighter immigration policies, which are hitting sectors like construction and restaurants. So does this mean these policies are now starting to erode U.S. domestic demand and, by extension, corporate earnings growth? And if this slowdown does persist, which sectors of the market do you think are most vulnerable?
There are some high-frequency data out there that do suggest that the slowdown has already started, so the more vulnerable bits of the economy. And generally, the sector that is one of the most vulnerable in this part of the cycle is the consumer discretionary sector. This consumer discretionary, they make things we don't really need, things that we buy when we feel like splurging, when we feel rich. So, for example, that pair of Crocs sandals, that Haagen-Dazs ice cream, that 10-day vacation to Japan, that spa treatment for your family pet dog, or just dinner at Hai Di Lao. So all these are stuff that we don't really need if we're feeling a little bit tight. And those are the sectors or those are the kind of products that would tend to be, turned down early on when we get into this part of the cycle. So yes, it could be time to transit out of those sectors and move into sectors which are a little bit more stable, a little bit lower beta, that's what we call in the industry, to kind of make it more resilient.
Well, the Federal Reserve is also in the spotlight. Markets expect a possible rate cut at the September 16 to 17 meeting, but Powell has stressed that inflation is still a concern. Do you think a rate cut would be enough to cushion markets against slowing growth, or could it simply signal that the Fed is more worried about the economy than what investors currently expect?
Well, the market consensus has already priced in a 25 basis point interest rate cut in the upcoming meeting. And we know this because we can look at the Fed Watch data on the Chicago Board of Exchange website. So there is a more than 99% probability or implied probability that there's going to be a 25 basis point rate cut. So actually cutting interest rates by that amount is not going to move the market in either direction. But we do have two more Fed meetings for the rest of the year, October and December. For the October meeting, there is a 55% probability of an additional 25 basis point cut. So if the Fed actually does carry that out, then of course it is a pretty clear signal that the Fed is more worried about economic slowdown compared to the inflation. So I think it's, so it's a little bit too early to tell, but let's see what happens in October and December.
Well, before we let you go, what else will you be looking at in the week ahead?
Right. So this week is all about employment. Next week is all about inflation. So U.S. CPI numbers coming out next week, Thursday. So that will be the other shoe dropping. And that will, of course, bring us full circle as to whether or not the economy is going to tank.
Well, okay. Thank you so much for joining me today, Benjamin.
All right. Thanks for having me. Always a pleasure.
That was Benjamin Goh, Head of Research and Investor Education at SIAS. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.